It's not your entry that's losing you money, it's your sequence. Most traders see a setup, get excited, and jump in the second price looks right. No context, no confirmation, just a gut reaction. That's why the same pattern that wins for one trader blows up another's account. There's actually a specific order things need to happen in: a weekly level clue, a trap, and a confirmation before you should even think about clicking buy or sell. Miss the order, and you're just gambling with extra steps. Get it right, and entries stop feeling random. Let me show you the exact sequence. Part 2. The framework. This model runs on 3 steps, always in this order. Step 1. Weekly candle context. Before you touch a lower time frame, look at the current weekly candle. Is price trading near a previous week's high or low? That level tells you where the market is likely to react. Your rule: no weekly reference point, no trade idea yet. Step 2. Liquidity sweep. Price pushes through that weekly high or low, running the stops sitting there, then snaps back inside the range. This is the trap. It's designed to pull in breakout traders right before the real move happens. Rule: you need to see price close back inside, not just wick through. Step 3. CISD. Change in state of delivery. This is your structural shift, the moment the short-term order flow flips and confirms the sweep was real. Rule: no CISD, no entry, no matter how good the setup looks. Here's where most traders get it wrong. They see the sweep and jump in immediately, skipping the CISD confirmation entirely. That impatience is what turns a high-probability setup into a coin flip. Remember it like this: weekly candle gives direction, the sweep gives permission, CISD gives execution. Let me show you exactly how this looks on the chart. All right, pull up the chart with me. First thing I'm doing is marking last week's high and low. That's our weekly context. Nothing else matters until price interacts with one of these levels. You can see over here, price grinds up into the previous week's high early in the session. This is where most traders would already be looking to short, but we're not doing anything yet. We're just watching. Now watch this candle. Price pushes above the high, grabs that liquidity, and then closes back below it. That's our sweep confirmed. Not a wick, a full close back inside the range. This is where people usually pull the trigger too early. We wait. So now we're watching lower time frame structure for the CISD, and there it is. You can see the short-term structure breaks, delivery flips from bullish to bearish. That's our green light. Entry comes on the retest of that CISD level. Stop loss goes just above the sweep high. Tight, logical, protected by the trap itself. Target is the opposite side liquidity, the prior week's low, which is our draw on liquidity. Let's check another example so you can see this isn't a one-off. Same story. Price sweeps the weekly low, closes back inside. CISD confirms the shift bullish this time. Entry on the retest, stop below the sweep, target up at the weekly high. 2 different weeks, 2 different directions, same exact sequence playing out both times. Continue to Part 4. Part 4. Callback and close. So that entry wasn't random. It followed the sequence every single time. Weekly candle gave us direction. The sweep gave us permission. CISD gave us execution. That's it. That's the whole model. Now, spotting all 3 of these manually in real time takes practice, which is why I built a tool that automatically marks the weekly levels, flags the sweep, and highlights the CISD the moment it forms, so you're not second-guessing yourself in the moment. Links below if you want to check it out. And if you want to see how this same sequence plays out on a different pair, the next video breaks down a full week step by step. Go watch that next.